Welcome. In this video I'm going to talk about tax and its relationship to money. To be clear, I am not an economist or finance expert. What I'm presenting here is the results of my reading around the topic, and some of those sources will be given at the end. Let's jump in with the most unpleasant aspect of tax for most people. The payment of taxes results in the reduction of wealth, in some sense, of the person paying it. We'll come back to what sense later. On the basis of this solitary observation about tax, someone of a libertarian bent will assert that this makes taxation immoral. In this video, I intend to show that that is not an absolute moral judgment, and in some cases it is in fact 180 degrees in the wrong direction, that paying adjudicated tax is both moral and necessary. But let's start with a more common intuition about tax, that is, that tax is levied on a population so that a government can undertake spending for the benefit of that population. This diagram aims to show the relationship between government, society and money. This yellow oval delimits the society we're discussing, and within it we have these economic agents, E0, E1, etc., and we use uppercase E to talk about all of them together. Uppercase F represents the currency, and the subscripts label what the currency is being used for at this point. So, FC is the total circulating money in society, FT is the tax being collected from society, and FS is the money being spent by the government, which is represented as an abstract entity, this box, but in reality, of course, formed from within society. FS equals FT is the notion that one has to tax to then spend, but is this intuition correct? In the past, wealth was taken from the people by rulers, sometimes to spend on the people, though more often than not to spend on themselves or their causes. Think of the Crusades or the Napoleonic Wars. But since those times, the nature of money and taxes has evolved and become a very different animal, particularly since the major currencies of the world left the gold standard. What this means is that the tax to then spend is not a necessary mechanism in such a changed money system. I'm going to call this changed money system sovereign money. In a sovereign money system, the currency itself is declared as such by the government. This is often referred to as fiat currency, a term beloved of the cryptocurrency bros. Hence my use of the letter F to denote it in the diagrams. We have two clear rules in the operation of this fiat currency. 1. The government, and only the government, can authorise the creation of sovereign money. And 2. Tax can only be paid with sovereign money. With tax to then spend, we now have two possible sources of money for use by the government. It can take it through taxation, or it can authorise the creation of new money. How does this change our understanding of the nature of taxation? Let's consider the state of a sovereign money system at the moment of its creation, its year zero, if you will. At year zero, FC, the circulating currency, is zero, so it's impossible for the government to collect any tax. In order to get the economy going, the government must use our first rule and authorise the creation of some amount of money, and that must somehow make its way into society. This could be done by the government itself spending money on items it needs, like buildings, workers, etc., or it could distribute the money directly to those who will use it. In both cases, money ends up with the economic actors represented by E. At this point, we can clearly see the purpose of money, that is to spur on economic activity by allowing each of those lowercase e agents to exchange goods and labour and thus, hopefully, generate wealth. But note that in doing so, the money just moves around between those agents. It is not itself changed in any way. Which brings us to the true nature of sovereign money in society, which is as a catalyst of economic activity. In chemistry, a catalyst enables or even speeds up a chemical reaction without undergoing any change itself. Similarly, money is neither lost or destroyed in the process of the economic activity that it enables. So now there is money in society. Should the government now collect tax? As we just said, money is there in society to catalyse economic activity. If we remove some of that through taxation, we run the risk of impeding that activity. Indeed, It might even be advantageous to society for the government to generate another tranche of money to insert into society to create more economic activity. We see then that the intuition that a government must collect sovereign money to then spend is not necessary. So how should we understand the operation of a sovereign money system? Here is my suggestion. When the government authorises money creation and spending into society, we should think of this as a loan. Remember, money is not changed or destroyed as it catalyses economic activity, and as it was created at the direction of the government, it can be considered as belonging to them. What that means is that when the government directs society to return some or all of the money loaned to society, it should do so. That process of returning money to the government is what taxation is for, and we can now see clearly the riposte to that of the libertarian view of taxes. Any decent morality would demand that you return something that was loaned to you when you so requested. Taxation is the return of sovereign money to the government, which owns all such money, and so taxation cannot be considered immoral in this case. In fact, not paying your adjudicated tax, returning a loaned item, would be the immoral action. So when do we invoke taxation and why? Undoubtedly, many of you were screaming inflation at the screen as I described generation and inserting sovereign money into society. So let's discuss that issue. Inflation can be down to many factors in an economy, such as issues with supply of an essential raw material like oil, as we've seen recently. However, our concern here is the possible inflationary effects of money creation and insertion into the economy. For this discussion, we'll consider actual wealth as stuff that belongs to and used by you, such as clothing or food, etc. And we'll consider money as potential wealth. That is, you can use this potential wealth to acquire actual wealth. Since money has no intrinsic value, it is in itself not actual wealth. But at any point in time, a set amount of money will get you a set amount of actual wealth. Inflation, or indeed deflation, will change the amount of actual wealth you can acquire with a fixed amount of money. If the cause of such change was due to having too much money in society, we would do well to remove some of the money to try and control such inflation. This then is the primary purpose of taxation in a sovereign money system. We of course still need to work out where such taxation should be applied to manage inflation at this point in time. What is important is that, having been adjudicated by the government as being required to pay some tax, then you should do so, because, as mentioned earlier, money doesn't belong to you, and the owner is asking you to give some of it back. But there is a further consideration. If you decide not to pay your adjudicated tax, you will in fact be contributing to the reduction of everyone's potential wealth, even your own. You may think that this is worth the risk, since you'll have more potential wealth anyway by not paying your tax. Of course, this would apply to anyone, and the more people who don't pay their adjudicated tax, the more everyone's potential wealth will be decreased due to the resulting inflation. This seems like another moral reason to pay your adjudicated taxes. It also looks like a situation for analysis by game theory, which may provide a mathematical justification for paying your taxes. We can see that this kind of taxation reduces your potential wealth, not your actual wealth, and this might be reduced further by others not paying their adjudicated taxes and thus causing inflation. If taxed sovereign money isn't needed for spending, what should happen to it? Quite simply, it is destroyed, as shown in this modified diagram. The government needs to know how much has been collected in taxation, represented by the dotted line, but it doesn't need the money itself since it's capable of generating any money it requires. Bookkeeping collected taxes across government to then spend is unnecessary effort. So in summary, sovereign money is very different to money of old and of current intuition. It is in fact a catalyst for economic activity in society. The creation of sovereign money is authorised by the government and inserted into society as a loan, which is returned to it via taxation. Sovereign money is potential wealth, not actual wealth, and the relationship between the two is affected by inflation or deflation of the currency. A government may seek to control money supply-related inflation through taxation, and if you avoid paying such adjudicated tax, you affect the potential wealth of everyone, including yourself. Given all these observations, I leave you to consider this question. If the government can authorise the creation of this sovereign money, why does it need to borrow such sovereign money? Clearly, despite being built on top of a sovereign money system, our current monetary system operates quite differently from the way I've described. How that is and in what way that's a problem, I'll come back to in a later video. The ideas presented here are based on my reading and studying of an area called modern monetary theory, or MMT. This seems to have arisen through the work of Warren Mosler, bringing together various notions, recent and historical, and has been recently expounded by Stephanie Kelton in her book, The Deficit Myth, Modern Monetary Theory and How to Build a Better Economy. What I would say is that only the first part of this book is about the topic discussed here, and that the title can be misleading. It's not that fiscal deficits are mythical. It is the fact that a sovereign authority does not need such deficits in a modern monetary system. Also be careful when reading about MMT, because sometimes what is discussed is a policy prescription made possible by an MMT understanding of money and not intrinsic to the operation of such a money system. For example, US MMT proponents will often discuss the idea of a federal jobs guarantee as a way for the government to funnel created money into the economy, but this seems to me to be based on the fetishization of paid labour as the purpose of life. An alternative to this could be something like universal basic income to achieve the same goal of generating useful economic activity. The other main influence on this presentation is The Joy of Tax by Richard Murphy. Although I don't recall it mentioning MMT explicitly, Murphy does discuss these ideas in his blogs and videos, which are linked in the notes. Thank you for watching. Any comments, questions or corrections can go in the comments section below.